All right, so the market has been open for a little more than 23 minutes, Sunday afternoon. And I'm going to quickly review an uneven iron condor that I placed on last Thursday. So we'll run through this here. An uneven IC, a UIC, was opened on August the 20th, the SPOOs, with a 5-day expiry of August the 25th. So this was a 5 DTE. And the first thing I did here was I bought a 10 wide call spread with the strikes being 76.90 and 77 even. I bought the 90, sold the even. And that was done for 340-ish. 340, and this includes commissions and fees. So the total cost of call spread was, here, let me give you an exact figure, $343.44. So the commissions and fees added $3.44 to the cost of $340. All right, the next thing I did as a hedge to this, and the hedge was to purchase a 75.85 put and sell the 75.80. So I'm purchasing put spread here, and that cost me $1, and commissions and fees added a bit more to it. So the total of the structure was $446.88, and that's a 10 wide call spread and a 5 wide put spread. Okay, the following day, I butterflied half of the 10 wide call spread by selling the even 05. The 5 wide call spread that I sold here to butterfly half of the 90 even, I sold this for $2. So that's going to bring in 200 in credits. And the first adjustment, we're going to call that, brings in credits after commissions and fees of $196.56. And that reduces my cost basis to $250.32. And this call spread was done within no later than 15 minutes, 10 to 15 minutes of the market closing on Friday. The market was rallying. I decided to reduce my basis, reduce some of the risk, and still leave myself an okay profit should the market continue to rally over the course of the next couple of days. So if we take a look at the analysis tab of this, let's go to, okay, so here we see the call spreads. And initially I bought the 90, sold the even, and then I butterflied off half of it by selling the even 05. Activity tab here will verify that. 340 for the initial 10 wide call spread, $1 for the put spread, and the butterfly, morphing the call spread into a butterfly, half of it brought in a credit of $2. If we look at the analysis tab, make sure that I'm only highlighting what we need to see. Here we go. All right, we'll look at the analysis tab here. We can see that between 76.90 and between 76.90 and 75.85. Okay, this is the area where if it closes in here and I do nothing between now and August 25th, I will lose $240. And remember, initially it was $440, but I brought in $200 by creating this butterfly up here. So let's go to this portion, the apex of the butterfly. Okay, this will be a 10 wide. If I pin the tail on the donkey right there at the apex, that 10 wide call spread would be worth $1,000. But my cost basis at this point is $240. So the max profit at the apex of the butterfly is $760. And beyond that point, if we go beyond 77.05, which is the next kink, this elbow here, I would make 500 less, and 760 minus 500 is 260. So anything beyond 77.05, this trade brings in a profit of 260. On the other side of the spectrum, should the market descend, and if it descends beyond 75.80, this put spread would max out at 500 minus my basis of 240. So that would also bring in 260. So 260 outside the boundaries of the spreads, and that would be a profit. And inside the spreads, I have a loss of 240. And this is seemingly a wide range, and you can say that it is, given that the expected move over the next couple of days. Let's take a look. It's probably going to be around 50. But let's take a look. Let's go to the... can I still use this? Yeah. Because if I can trade these things now, I can use this. So we're looking at about roughly 47 and a half-ish, 47 and a half, 48, somewhere around 47, 48. So a few handles under 50 over the next 2 days. And that gives me time and a little room for this to become profitable. Let's say that the market rallies to the upper end of the range. Okay, great, and it closes up there. Then I get a couple hundred in profit, 260 in this area between 90, 76.90 and 77.05. It's a little bit more interesting. However, let's say that sometime tonight the market rally is 50 points. So if it rallies 50 points, it's going to be trading around 77.25. And at that point, I will be able to, if I wanted to, for example, I could sell this for probably around 250. And I say probably because if it's trading here, if the market's trading in this area, then this delta is going to be around 50. So this 5-wide put spread is going to be trading for around half of that 5 value, so 250. Now note that that would bring my cost basis to positive. So rather than being minus or negative 240, the cost basis would be slightly positive. So I'd be free rolling across the board. Let's look at the analysis again. So now, rather than losing 240 in between the call spread and the put spread, which is basically a 105-point range, I wouldn't lose anything, and I'd still have a decent shot at a decent profit up above. If I sold this, the 2025, now note that I would get $1,000 for this 10 wide. Okay, this would hit max value, and I'd get a touch more because of the total credits received, and then I would get 500 between 05 and 20. So that's good too. So I get 500 plus the extra 10 here, 250 minus 240 is $10. So I get $510 between 05 and 20. And then beyond 25, I just basically break even. It's gonna almost pay for commissions and fees, which do add up, by the way. On the other side, again, I would get the full value of 500 on this put spread if it closed below 75.80 plus the extra $10. If the market rallied enough so I can sell this for 3, then note that it just increases the value that I'm going to get between the spreads. If I can sell it at 4, which I'm not saying I'm going to be able to, I'm not saying the market's going to rally because I don't know, then the worst case scenario is I make $160 between the spreads and $160 beyond 75 or 77.25, and then between 76.90 and 76.20 it gets interesting because I can make the max value on the 10 wide, and I would get an extra $160, so it would be worth $1160. And then between 05 and 20, I would get max value on a 5 wide call spread. That would be 500 plus the extra 160, 660. Okay, so this has some interesting possibilities. Again, I have no idea what's going to happen. This case that I just showed you was a favorable case for the position, favorable being the market rallying and continuing to rally sometime between now and expiration. Obviously, the sooner, if it's going to rally, the sooner it rallies, the better it is for this position. But I don't know that it's going to do that, and this open is a pretty quiet open, in my opinion. The market opened, the E-minis opened a few handles lower, about 4 or 5, and it's basically been sitting in this area the whole time. So we'll see what happens as the night progresses. All right, thank you for tuning in. I'll catch you guys next time.